Yeah. And I can tell you, we had huge put buying in there on Friday. And today, we're seeing those returns. As a matter of fact, the first two trades that happened today that we were seeing an unusual was the Spider. They were buying more Spider puts, about 28,000 of those. And then they decided to go after 30,000 of the IWM puts. So they just continue to come after these. And now there's even the EFA. And if people are not familiar with that, it's another ETF. And that's where we see a lot of this paper, Scott. These ETFs are really seeing the sizable paper. But in this one, the EFA, it's basically everything out in the world except the U.S. and Canada. And that's another one where we're seeing huge put buying. We've seen that in the past as well. So there's no doubt that that is the narrative of the day for me, and going back to last week, is they're buying puts expecting this thing to get a little bit worse and a little bit worse. And last week we did talk about this. We were talking about what was really shifting in the markets. It was the 10-year, but it was really the 2-year as well, because when you think about it, Scott, May 27th, the 2 years trading 248. Now here we are above 3.1. I mean, that shows you the velocity of that move as well. And that's, I think, what's really just hammering the markets right now.
We got 320 on the 2-year right now. That's a better than almost a 5.25% move. And Pete's right. 10%. The 10-year is 5 2/3%. It gives you an idea, as Pete's dead on in this velocity of the move higher in rates today. Kerry, put your years of experience of watching these markets and running portfolios on display for folks, and give me just an idea of how you're thinking about what happened on Friday carrying into today and where you think it may go from here.
So I think the most notable thing is the lack of faith right now that investors have in what they've been told by the Fed, what they've been told by the Treasury Department, what they've been told by companies and the management. So that's sort of been thrown out the window, because we can't seem to trust that the numbers that the Fed are looking at, have been looking at, which, remember, they used that word transitory for a very long time. They've stopped using that, and now we've got lots of inflation, much more than anyone really expected, that we saw in those numbers on Friday. And Janet Yellen and the Treasury Department, again, looking at the same numbers. These people are academics. They spend all their time coming through data. It hasn't helped. You have companies that are now taking down numbers, starting to hedge on guidance. That's causing people to be scared. I'm worried that what we've been hearing about unemployment has been wrong. The unemployment number being 3.6% has been one of the high points, one of the places that you could really hang your hat and say, wow, this can't be a recession if we have so few people unemployed. Maybe those numbers are wrong, and companies have been over-hiring just the way they overbought inventory. So what's the good news? So the good news is that if we take those numbers down on earnings for next year, instead of 250, look at 235 on the S&P, and multiply that by 15 times, a multiple of 15 times. We're not that far away. That's 6.5% below where we are right now. We can do that in 2 days. We've been doing that recently. So I'm not suggesting that this is the place to buy, but it can be comfortable. We can be comfortable at a level, as Jeremy Siegel said, that's not too far down from here.
Well, the problem, Liz, is that if I ask you what's the right price for stocks, you can't answer because you don't know. No one knows. What's the right price of earnings? Can't answer that. You don't know. No one knows. Is the multiple down enough? Down to 16 times from 21.5 at the start of the year. Is that enough? Can't know that question before you know the other questions, which are unattainable right now.
Yeah.
That leads to the uncertainty that markets traditionally hate, and that's what we're in the middle of.
Absolutely. And I think this continues. But look, Friday was a terrible day. Today looks to be another terrible day. And on some level, I welcome it, because we had tried for a while to really confirm capitulation and try to confirm that we had gotten down as far as we were going to go. I want to just get it over with. So let's just have a string of bad days, maybe a couple bad weeks, get it over with, flush it out, and then wait for the next set of data. But in this next few days here, I don't know that it's going to stop anytime soon. And I think the question you have to ask is, how low does it have to go before it bounces? It's not necessarily what's the right multiple. It's what's the right multiple for it to bounce off of. And I think that there's still further to go for that.